Hi everyone, a very good evening. You're watching The Money Show on ET Now. I'm Mubina Kapasi. This is a show where we get you everything to do with your personal finances, ensure that you are on the right path when it comes to proper financial planning, as well as, of course, ensure that you are on the path for long-term wealth creation. Let's tell you what we have lined up on today's episode of The Money Show. First up, markets are at record highs, or in fact just about near record highs, because today we did see the equity markets correct, but nevertheless we've done very well on the Lal Street. We're firmly above 13,400, so that is something that's definitely noteworthy. Now, how should you really use this rally in the markets? We invest in the equity market so that we can really profit from the kind of rallies that we have seen in these last couple of months. So now the question is profit booking, exiting. That's going to be extremely important to understand, and that's what we will be understanding with Mrin Agarwal, who will join us in just moments from now. And later on the show in our Spend with TMS segment, home prices have fallen quite significantly. If you have investable cash, should you use that money to buy a second home from an investment purpose, if not consumption purpose? We know, we've heard from a lot of individuals that this is the best time to buy a home for self-consumption, for those individuals who've been scouting a home for themselves. But what about from an investment purpose? Because we know what rental yields have been. And the guest that we have today has actually got a very interesting proposition. Invest in a second home, but perhaps not in the same city that you live in, but in a different city, further away from the metro. So we'll be getting that on board as well. That will be, of course, a part of our Spend with TMS segment. And of course, as always, as we usually do on The Money Show, we will be answering your questions and queries. So you can write them into us on The Money Show at etnow.tv, and we will be in touch with you regarding the same, about how and when we will be answering your questions. So whether it's with respect to your mutual fund portfolio, your investments, write into us. Okay, well, let's take on board our very first guest on the show. Like I mentioned, Mrin Agarwal joining in today on The Money Show. Mrin, appreciate you giving us your time today on The Money Show. Many thanks for joining in. So to start with, Mrin, let's just get in your take on, what we are seeing in the markets, perhaps aided by this whole news that the vaccine may finally be here. Of course, back home in India, it may be a little delayed, but it will come sooner or later. It's already started in the United Kingdom. It'll start very soon in the United States and the rest of the world as well. What do you think? Is this massive market rally that we've seen, do you think it has more legs? What's your opinion?
Very difficult to say. Of course, it's been led by this huge FI inflows that have actually come in this month, pretty much more than the flows that we had seen going out in March. So really led by that, and hopes, of course, of the vaccine. Honestly, I think it's anybody's guess as to which way the markets are really going to go. I would love to see a correction, because it would allow me to put in money into the market. So that's what I would like to see.
All right. Okay. So how should essentially individuals, use this rally? There will be some people who, have invested only for the long term, but there may be some people who have, maybe retiring or maybe having to achieve a certain goal in the coming years. Should this rally then be used to reduce exposure to equities, or let's not say that. Let's say, should they use this rally to, book certain profits? Who should use this rally?
Well, I think for any investor, and since we are talking at the calendar year end, I think this is a good time to basically have a relook at what your asset allocation in your portfolio is. If you're skewed towards a particular asset class, so let's say, you started off with, let's say, 60% debt and 40% equity. And now if it's become the other way around, so let's say 60%. So I think if you're off by more than 15 to 20% from the invested allocation, certainly I think it's time for you to look at rebalancing your portfolio back. In fact, if you look at most of the balanced advantage funds, that's what they do, right? So they have basically reduced exposure to equity at this level. So essentially look at rebalancing. And with respect to if you have a goal 1 to 2 years down the line, it's always recommended that you should be constantly checking the value of your investment when you're close to your goal. And if it is close to your goal amount, then I really think that you should at least pull out that goal amount. So 2 things you can do for any long-term investor. It's always good to do some amount of rebalancing from time to time. And for those who have goals coming up in the next 1 to 2 years, certainly utilize this rally to convert some of that money into safer instruments towards your financial goal.
Okay, so this you would of course recommend those individuals who have their, their goals, their goals which may be coming up in the next 1 or 2 odd years. Where should they park their money in the meanwhile? They've booked their profits, they've taken that money out, but you still have about a year or something. And this is also an important question because many a times people just park them in their savings account. So where should they park it in the meanwhile?
Well, clearly, if it's for use within the next 3 years, 2 to 3 years, it should be parked in ultra short-term debt funds or in low-duration funds, and that is if the holding period is below 3 years. For other investors who are doing it more from a rebalancing basis, again, towards their long-term goals, it needs to go back into the same debt instruments that you have invested in earlier. Of course, keeping in mind the investment horizon towards your goals.
So let's say if, an investor, Mrin, has their kids' foreign education that's going to come up in maybe 2 years from now or 3 years from now would be a good time to take some money off from their equity mutual funds and maybe park it in one of the funds you mentioned?
Yeah, absolutely.
All right, excellent. Okay. But for those individuals who, have long-term goals, wealth creation, retirement, and then, of course, there's this wonderful rally seen in the equity mutual fund, in equities. Mrin, back when gold had rallied very, very significantly, we say that gold should be a certain part of your portfolio, but the way gold had rallied, the exposure to the portfolio had actually increased quite a bit. The portfolio's exposure to gold, pardon me. If that is the case with equities, do you think some rebalancing is necessary for long-term investors?
Yes, absolutely. In fact, on an annual basis, one should look at rebalancing the portfolio because what you're really trying to do is that you're trying to protect your portfolio from the risk of overexposure to a particular asset class. And at some level, it's always good to also realize profits from time to time. So I feel that this exercise should be done on an annual basis. It could be done at calendar year end. It could be done at financial year end, depending on what the investor wants to do. But certainly, even longer term investors need to utilize this rally to rebalance if their portfolio allocation has overshot by 15 to 20%. So if they had started with, let's say, 30% equity and it's become 45%, then maybe they want to rebalance back to 30% and put the amount that you're going to get needs to be reinvested into the debt funds as they have allocated earlier.
All right. So it's important that, your portfolio is not overexposed to a certain kind of asset. I'm sure when you sit down with your, financial advisor, your money manager, there's a predetermined asset allocation. which is decided based on your profile, your objectives, your risk-taking ability, and you really shouldn't waver very significantly from that. How does that happen? Well, when one asset class rallies quite significantly, and that is something that we have seen happen to gold earlier, especially during that whole period of July and August, and now we are seeing it happen to equities as well. Mrin, by the way, since we are talking about asset allocation, what would be your ideal asset allocation? And I know your answer is going to differ for various age cohorts. So let's start off by understanding your asset allocation plan for the 3-4 age cohorts.
Well, certainly if you are in your 20s, I think it should be at least 70% equities and 30% debt. For people in 30s, probably like 60% equities, 40% debt. And the reverse once you get into your 40s, basically. So then you're talking about 60% debt and 40% equity.
All right. By the way, Mrin, another question, and this is something that a lot of investors do tend to ask us, that they say that, the market has rallied. I see everywhere on, televisions that, okay, the market has recovered to pre-COVID levels, or the market is at multi-month highs and now, of course, at record highs. But my mutual fund is not reflecting that sort of enthusiasm. Mrin, when do you sort of... what is a telltale sign that, okay, listen, this mutual fund is an underperformer and you should probably just move out? And in which cases do you just simply have to adopt patience?
So with any fund, you must remember that all funds go through cycles. So if you look 2 years back, the funds that were the top performers are no longer the top performers right now, even within the multi-cap space or even within the large cap space. So I think what is very important when you're evaluating any fund performance, it has to be relative to the category average. It has to be relative to the benchmark for that particular category. And if you see continued underperformance for more than 18 months is when you should actually look at exiting the fund.
All right. Okay, so there are certain cycles, that some of these mutual funds do go through, and that is something that you just have to sort of understand and realize that, okay, your fund is in a particular cycle at this point of time, so you shouldn't be too perturbed. And of course, we're always here on the Money Show, where you can always send in your questions and queries with respect to your portfolio, and we'll sort of try and get it answered. Well, speaking of questions and queries, let's get straight to that. We have a couple of them received. Remember, you too can get in touch with us. The Money Show at etnow.tv is our email address. Aditya Bodhi has sent his email saying, I've already invested in the following mutual funds 2 years ago and wanted to invest more in a staggered manner. He has the L&T Mid-Cap Fund, Motilal Oswal Multi-Cap 35 Fund, Principal Emerging Blue Chip Fund, and the Aditya Birla Sun Life Equity Fund. He says he's investing for his son's education, which he will need after 15 to 18 years. So he's definitely got a really long-term horizon. He wants to know now from you, Mrin, if this is a good mix of funds to own. So one blue chip, one large cap, one multi-cap, one mid-cap fund. What do you think of all of these funds, Mrin? Will they help him achieve his purpose? Primarily at this point of time, he's just investing for his son's education. Unfortunately, he's not written the amount, but we know that he's got a long time.
I think given that he's got a long time, I do think and I do hope that he'll be able to achieve his goal. Certainly, I think the choice of funds is okay. And I know that a couple of them are underperforming at this point in time. But as I said, most funds go through cycles. And what is really important is just to remain invested during this period. I think he's got like a good split between the mid-cap. Of course, we don't know how much he's invested in each one of these funds. But as such, I think the funds are okay. And I think he should just hold on right now.
So the funds seem to be okay. You can just hold on. That's the word coming in from Mrin. Aditya, And it's great that he's already keeping in mind the fact that his son at 15 or 18, whatever his academic ambitions are, Aditya will be ready to sort of help him out achieve the same. Okay, moving on, we have Jayandar, who says that I have the following funds that I've already invested since 2019. They're all for the long term, and they're all Axis funds. So there's the Axis Blue Chip Fund, there's the Axis Mid Cap Fund, the Axis Small Cap Fund. He wants to know if this portfolio is okay, if he can continue it, and to further diversify, he's planning to pick one fund each in each of the categories. So he wants your, what would be your choice, Mrin, in the large and mid-cap category between Mirae, Canara Robeco and Invesco. Similarly, he wants to know what your choice would be in the multi-cap funds from Parag Parikh, Canara Robeco or Kotak Standard Multi-Cap. His time horizon is 5 years. And also he wants to know about ELSS funds. So there his choices are Axis, Mirae and Canara Robeco. So Canara Robeco seems to be the commonality in all his categories. Mrin, firstly, what's your opinion of the fact that he has chosen all his three funds from one AMC? I mean, is that okay? Is that okay with you, or do you advise choosing different AMCs? And of course, if you could help Jayandar diversify with the other segments that he's asked you to pick from.
So, when we talk about diversification, and we've talked about this very often about the overlap in stocks. And when I check the overlap in stocks in these funds, it's about 17 to 20%. So the overlap is not that high, But I think what the issue is that you're going in for the same style of management across your portfolio. And and I think it's really important to also see that, that you're not in the same style, because that's what diversification is all about. I think most of the Axis funds are primarily invested in cyclicals. Also, if you look at the correlation of returns, they're pretty correlated in that sense, not in terms of the portfolio. So certainly, I would say that within the market caps, please spread out in different styles, which means different funds, because each fund manager has his own style of investing. So certainly no more Axis funds. Now, he talked about investing for a period of 5 years. And honestly, 5 years is a very short period for an equity fund. I would not recommend it. I would say at least 7 to 10 years. So if he still wants to hold only for 5 years, then I think he should go in for the hybrid equity funds. So he can choose balance funds, or I like the balanced advantage category, which is the dynamic asset allocation category, the best for a 5-year period, because it does this automatic rebalancing. However, if he can hold on for long term, which is 7 to 10 years again, from the funds that he has mentioned, I would suggest, of course, the Parag Parikh equity fund. It comes under the new flexi cap category as well. So does Kotak Multicap. It also comes under the new category. And on the ELSS side, I would suggest the Mirae Tax Saver. I wouldn't recommend getting into any of the large cap funds.
All right. Well, there you have it. That, of course, is about, how Mrin would recommend you go about investing in different segments, how you could split it as well. And I think his question on ELSS funds as well is quite timely, because it may seem like the year has just begun, but guess what? The financial year is actually about to end. We just have about 3 months to go. So if you guys haven't got about it, you need to start your tax planning, because before you know it, it will be 31st of March. And it's very, very unlikely that the FM is going to give you some relief on the tax investment bit this year at least. Mrin, on that note, we'll let you go. Thank you for joining us today on ET Now and on The Money Show. As always, pleasure having you with us. Ladies and gentlemen, if you would like to relive this interview, you can do so by logging on to ET Now's YouTube channel. And of course, scour for The Money Show playlist. On that note, we'll take a very short break.